Hello. Most of us tend to buy and hold our investments, but how do you buy and manage as opposed to buy and hold? Well, on this episode of The Pitch, you're going to find out how Ryan Quinn and his colleagues at WCM Investment Management deal with the opportunity in global growth equities, and indeed, how they are making hay while the sun shines in this very popular asset class right now. Ryan, welcome. Let's just start right at the top. How are you seeing the opportunity set right now, just given that equity markets are at all-time highs and this bull market has been propelled by growth stocks?
Yeah, I think the risks for the average investor out there are buying the broader market, right? Because you're correct, the valuations are at very high levels, and not all businesses are created equal. Where we differ at WCM is we manage a concentrated portfolio of 35 to 40 growth stocks, and so we're selecting only our favorite ideas in the world that we can make the case that are going to grow, and when things are valued highly, as long as you grow your earnings, that valuation takes care of itself. So for us, the answer is stock selection and active management.
Yeah, no, absolutely. I mentioned at the beginning of this interview that often investors tend to buy and hold their stocks. But why do you and the team say that buy and manage is a better approach when it comes to this particular asset class?
Yeah, I think the business cycle changes, right? And there are different environments that are going to be better or worse for different stocks. And if you are lucky enough to buy a business or the shares of a company that rapidly increase, it's our view that you should be diligent about managing the size of that position. Because usually when something rapidly increases, it does create an air pocket below it, and any sort of hiccup or bump in the road for the world can lead that stock right back down to where it started. We don't want to have 2 or 3 positions be 20, 25% of the portfolio. That's a way to make money when everything's going up, but when everything's going down, it's a very fast way to destroy capital, and we're in the business of protecting capital.
With what you've just said in mind, does this approach mean necessarily that your holding periods for stocks in the fund tend to be lower or less time, or not necessarily?
No, our average holding period matches sort of our view of how we're doing research on companies. We always take a 5+ year time horizon view, and our average holding period is right around 5 years in the portfolio. If you look at our turnover statistics, the portfolio turns over about 30% per year, but half of that is adding and trimming to existing positions. And what we've learned over time through backtesting things is that trading and that buy and manage exercise has led to alpha over time.
So when people think about global growth equities, I think they probably think of AI, right? It's been the dominant market tailwind for some time. But what are some of the other secular tailwinds your team has identified?
Well, in the healthcare space, were it not for AI in 2023, the biggest trend in that year would have been GLP-1s, which are the glucogen-like peptides that are helpful, that had been previously only helpful for managing diabetes and insulin levels in patients. The side effect of these GLP-1s is weight loss. So now that there are obesity drugs, so being able to impact the global problems of diabetes as well as obesity not only is an incredible runway of opportunity for businesses like Novo Nordisk and Eli Lilly, but it's also going to have a wave of impacts throughout industries. I mean, think of everything from general healthcare. People are going to be living longer. Think about it as it looks to retail. Maybe casual athletic wear is more approachable for a broader audience. The hospital systems, there's going to be positive impacts on cardiovascular disease, kidney disease, which will put less of a strain on the hospital system. Maybe healthcare prices, God forbid, come down.
Wouldn't that be nice?
So that's a very large trend that we're taking advantage of in our portfolio. And then also there are some trends that maybe hadn't been appreciated post-COVID, and one of them being aerospace. So we're getting exposure to the engine industry as it relates to commercial as well as military aircraft.
So if I kind of press those two themes then, the aerospace and the healthcare, I was wondering if you could tell me about a couple of current holdings that you have exposed to these tailwinds, maybe in healthcare as well. I mean, do you own Novo Nordisk and Eli Lilly?
We do. We don't own Eli Lilly. We've owned Novo Nordisk when it was just a diabetes drug. That was the original thesis. And We like Novo because it's very laser focused on that one space. Now their Ozempic, which is the diabetes drug, has been relabeled as Wegovy, which is their obesity drug, and it's had a fantastic run for us because of the efficacy of the drugs, because they are showing these benefits in other areas like cardiovascular and kidneys. There's also a number of different tests going on in areas like addressing Alzheimer's through GLP-1s. So we're really kind of at the forefront of some pretty exciting medicines in that space, and the impact of a healthier world it can be extrapolated to a wide number of industries.
So that's in healthcare, and then in aerospace. I mean, are you owning the Boeings and Airbuses, or are you kind of looking one level below that? Or
yeah, rather than owning either of the airplane manufacturers, we prefer to be in the jet propulsion business. So General Electric has an aerospace business. They recently spun off their electric nuclear business called GE Vernova to become a pure play aerospace. So they make the middle part. An engine on a middle body airplane is three parts: the front, the back, and the middle. GE makes the middle bit. And what we love about this industry at the moment, not only is the dominance that GE has in that space in terms of having a huge market share with Boeing and Airbus for every single one of their planes, but the commercial airlines are requiring their planes fly for longer, which means that in addition to the initial sale of the engine, they're going to have much longer maintenance contracts that are very profitable for GE Aerospace. As you can imagine, keeping those engines running and working very, very well, hopefully flawlessly, is in everyone's best interest. Having flown over the Pacific to get here, I'm hopeful that that they continue to keep those maintenance contracts rock solid. But it's an area that had sort of gone into a bit of a dip post-COVID, and so we were expecting to see that area of the market pick back up.
I hope the engine continues to operate. Ryan Quinn of WCM, thanks for coming out and joining us there from California as well. And thank you for joining us for the pitch. If you enjoyed that interview, you can subscribe to the Live Wire Markets website as well as our YouTube channel. We'll see you again when we see you. Take care.